This is Sarah Cage, and I'm joined again by my co-host Adam Olsen, Embark's national quality leader, and back by popular demand from her dad, her biggest fan, Nicole Harger. Nicole, you have a good story about your dad watching these podcasts, don't you?
Hey, yes. He likes to give me constructive feedback. There's been improvement. Hey, you guys are asking me back for a third round, so I think we're good.
Yep. Tell them to rate, review, and subscribe. All right. Well, it's that time of year again, the holiday season. Everyone is focused on their holiday shopping. Retailers are focused on sales. And so we figured there's no better time than to talk about accounting for assets held for sale. So that's what we will be digging into today. And to kick us off, let's start with what are assets held for sale? What do we mean when we say that? And when might a company come across having to consider this?
Want me to take that one?
I would love that.
Awesome.
Always start with you, Adam.
Yes, of course. Well, I don't know. You might mix things up every now and then. Yeah, but for sure. So assets held for sale are, essentially going to be relevant whenever the entity, plans to dispose of an asset or maybe a group of assets and liabilities, which is often kind of referred to as a disposal group, obviously by sale. And there can be, a variety of reasons why an entity, might be selling off a disposal group. It could be a strategic opportunity there where, maybe they're no longer pursuing a certain line of business or a division or something along those lines. And so they're looking to kind of dispose of that to a willing buyer. Or on the flip side, in more distressed situations, if you think about an entity that's maybe cash flow strapped and they're looking for ways to generate some cash flow, they may, search to sell off, certain assets they don't plan to use in operations or a division that isn't maybe profitable or something along those lines, in order to, mitigate going concern issues or something along those lines. In order to be classified as held for sale, so the guidance is in ASC 360. There are specific requirements that have to be met. That being said, not all assets that end up getting disposed of or even sold for that matter are necessarily going to qualify to be classified as assets held for sale. So just something else to kind of keep in mind.
All right. Well, I know we're here to discuss assets held for sale, but sometimes I like to go on little bunny trails. So really quick, if assets are disposed of by something other than a sale, is the accounting different?
Yes. So in short, yes, the accounting is different. So if you're going to dispose of, an asset or a group of assets or a disposal group, but it's not going to be through a sale. So, a common example is just an entity decides maybe to abandon like a group of assets because they're not going to use them anymore. Those assets are going to continue to be classified as what we refer to as held and used. So kind of like how you view all other assets until obviously ultimately they're abandoned. So they won't qualify as being held for sale because they're not being sold. One thing to keep in mind is when there is a plan to abandon assets, there can be other like accounting considerations that come into play. So like namely like impairment because you're no longer planning to use the assets as intended, or if there isn't an impairment related to it, maybe it's just revising the useful life because you're disposing of them or abandoning them sooner than maybe originally anticipated.
All right. Well, I'll hop back off my bunny trail and get back on track. So let's start by looking at the requirements to meet the held for sale classification.
Okay.
Say we have a company considering disposing some of its long-lived assets by sale. What's step one?
Yeah, so I think the first step is obviously just figuring out what are we getting rid of, right?
Yep.
So what assets or maybe assets and certain related liabilities do we plan to dispose of by sale? Usually it's pretty obvious, especially on the asset side, what you're getting rid of. Sometimes if liabilities are going to be included in the disposal group, just making sure you understand which liabilities to include, that they should be really directly related to the disposal group being transferred to the buyer, their legal obligations of the buyer. Those are the types of liabilities, if they are included in the transaction, to include in that disposal group. So common ones that usually come into play, sometimes there will be trade payables included with maybe the disposal group. There could be lease liabilities if you're transferring some lease arrangements with their tax, or legal implications, things like that. If they are, legally obligated for those, they could be other types of liabilities included. But once you kind of figured out what is going to actually be disposed of, whether it's a single large asset, a group of assets, a disposal group made up of assets and liabilities, the next is to walk that, that disposal group through the classification criteria for held for sale. And there's essentially 6 criteria that all have to be met in order to qualify.
All right. Well, that sounds pretty easy. So let's take it one at a time, starting with the first criterion, management committing to a plan. Nicole, can you talk a little bit about that for us?
Yeah, so essentially there needs to be an adequate plan in place to sell the disposal group. Generally, this plan includes, as Adam alluded to, the assets and or liabilities that make up the disposal group, significant actions that management has to take in order to complete the plan, as well as the expected time frame of the sale. And generally speaking, all of this is a well documented, right?
As with most of accounting.
Yeah, it's hard to argue you have a sufficient plan if you haven't probably put it on paper.
It's up in my head, I promise. Yeah. So let's say the company has commitment issues. They're not willing to commit to a plan. Is this criteria not met then?
Yes, that's correct. So if the company does not have a clear plan, this criterion is not met. So in other words, if they're just exploring a possible sale,
shopping around, dating a little bit.
Yeah, exactly.
What am I worth?
This criterion would not be met. For further, I guess essentially, all appropriate approvals for the plan must be obtained for this criterion to be met. So if a company's governance policy or ownership structure requires management and or board approval, and that approval has not been obtained yet, this criterion is also not met.
Yeah, and I would just also add is sometimes the governance structure will also require shareholder approval, and whether or not true shareholder approval is necessary to also show that a commitment to a plan has been made. Really kind of just depends on who controls the company as part of the shareholder group. In a lot of cases, management or members of the board are already part of the majority shareholder, and so their approval through the shareholder process may be perfunctory because they're already approving it through their board representation or as a member of management. So it kind of just depends there whether or not the shareholder approval could also be an additional layer.
All right, that seems relatively straightforward. So what about the second criterion?
Yep. So the second criterion is that the disposal group must be available for immediate sale. So in its present condition, the disposal group, for lack of better words, must be ready to go. And it's subject to terms that are usual and customary for sales of such assets. But generally, the company has to have the intent and the ability to transfer the assets. So, for example, a company is looking to sell a building, and in preparation of that sale, they decide to do some major renovations. In that situation, this criterion would not be met, as the office building is not available for immediate sale. However, if there are capital improvements that are more routine and customary, such as scheduled repairs and maintenance, that would not preclude the asset group being ready for immediate sale. It's also important to note that this criterion does not restrict a long-lived asset or disposal group from being used. So if it is available for immediate sale, the remaining use of the assets or disposal group is really incidental to its recovery, because the carrying amount is generally recovered through the sale. In addition, it also does not require, this criterion does not require a binding agreement for a future sale. So when the FASB was deliberating this guidance, they really concluded that requiring a binding agreement would really inhibit timely classification for assets held for sale. It's just important to point out too that if there are terms that are really delaying the sale, they should be analyzed to see if they are usual and customary.
Okay, I'm going to double click on that last phrase right there. What do you mean when you say usual or customary terms?
So it's going to vary by entity as well as the terms of the agreement, but commonly this could include things like buyer due diligence, regulatory or lender approval of the sale. There could be other terms that exist that would need to be considered, such as like a down payment on our sale or timing of transfer of the disposal group.
Okay, that makes sense. So let's move on to number 3. What's criteria number 3?
Yep. So criteria number 3 is the company must have an active program to locate a buyer. This one is pretty straightforward. The company has to essentially be marketing the disposal group for sale. A lot of times this is done through a third party. So let's say the company knows they're going to use a third party, but they haven't decided on who. This criterion would not be met.
So let's move on to the 4th criterion. And I know this is a big one that centers on the timing of the sale. So Adam, can you talk a little bit more about that one?
Yeah, so this criterion really focuses on that the sale needs to be probable of being completed within a year. And so you may be asking, why was 1 year selected? And really, the FASB, when they were deliberating this guidance and trying to think about, under normal circumstances and customary terms, what's the time period it would take for an entity to really kind of go out to market and find a buyer and kind of close on that transaction. And they felt that, 1 year was reasonable. Obviously, as we mentioned, with documenting things for your auditors and just, assessing this guidance as a whole, is that there can be a lot of subjectivity. And this is kind of one area where there is a lot of subjectivity because you're essentially trying to predict today that you're going to have a sale of this asset group this disposal group within a year. So, a lot of judgment that goes in there, especially when you hear the word probable in any accounting lingo. And so probable here, very similar to other areas of GAAP, it really kind of refers to the contingency guidance in ASC 450, which is basically translated loosely into that a sale is likely to occur within a year. And if you're a numbers person, the percentage you can kind of keep in your head in practice that a lot of people use is like a 75% likelihood. But again, it's that 1 year sale will occur kind of metric that you got to think about.
Okay, and are there any exceptions to the 1 year rule? Like, let's say a sale is expected in 13 months. Is the held for sale classification out the door?
Not necessarily. It would actually kind of depend on the rationale for maybe why the sale is expected to occur in a period beyond a year. So the FASB did provide kind of 3 limited exceptions to this 1 year rule. So the circumstances that could arise in kind of the course of a disposal group sale process that would be permissive. Is that a word? I don't even know. Okay.
Permissible.
Permissible. Yeah, I knew that. Anyways, sorry, little tangent there. That would be allowed.
Yeah.
If certain criteria are met. So, we can definitely take a deep dive into those. I'm sure that's where you were heading with this.
No, I was just going to move on. Let's definitely walk through each of those exceptions.
So the first condition, or I could say exception to that 1 year rule really relates to when the entity expects that there's going to be a condition in place that's not imposed by the buyer, but by some other party that's going to extend the period of when their sale can be completed beyond that 1 year time frame. And the actions required to respond to those conditions that are imposed on them can't start until they already have kind of a firm commitment for that purchase. And that firm commitment for the purchase is expected to be probable within 1 year. If you have all those factors aligned, you can essentially meet the exception to go beyond that 1 year because you've got someone putting something on your plate that you can't meet until you actually have a firm commitment in place. And so there's all these factors that would extend it beyond that 1 year timeline.
Yeah, so a great example of this exception is, we once had a client that was selling off a significant portion of their business. And the sale actually required approval by the Federal Trade Commission. So because of that, it actually took about 16 months from start to finish before the sale was complete. And so since those circumstances extended the time frame of the sale, the company proactively responded to the unanticipated circumstances. All of the other held for sale criteria were met. They were actually able to classify this disposal group as held for sale in 2 annual consecutive reporting periods. So,
Yeah, no, good example. So like regulatory approvals, some other type of legal approval, lender approval, things kind of outside, where they're waiting on someone else to do something and they got the purchase in place. They just can't close the deal yet. The second exception here is when you've got also purchase commitment has been obtained. But in this case, you've got a buyer that, kind of is imposing certain conditions on the transfer that weren't expected. And those conditions are going to extend the timeline of completion of the sale. But in addition to that, the conditions that are imposed by the buyer, you basically have to look at those and also respond and say, yes, we can initiate whatever remediations we need to do to meet those conditions. And we expect that there will be a favorable outcome for whatever conditions were put into place. So a common example here is, a lot of buyers are obviously going to do their own due diligence. Let's say they're buying like a set of buildings or equipment or something like that as part of the disposal group. And they go to maybe physically inspect those assets. And as part of that inspection, maybe there's a ton of unexpected damage or some environmental remediation that might need to be done that they weren't anticipating. And so as a condition to closing the sale, they say, hey, this wasn't part of the terms of the sale. We want you guys to fix all this stuff, clean it up, whatever needs to be done. And the seller, and looking at that is like, well, this is going to take some time. And so because of this, we'll do it, we'll start it right away, but it's going to take us more time that will extend us beyond that 1 year period, but we expect to satisfactorily meet those demands. All those conditions aligned, you could then also have the exception of the 1 year rule. And then the last one here is when you've got, you kind of go beyond the 1 year circumstances where you have kind of unanticipated factors that could come into play during the sale process. So, like unanticipated circumstances is one criteria. You're still kind of actively trying to market and sell the disposal group, and you've met all the other criteria, but there's just something like outside of control of the entity, outside control of the buyer that the potential buyer that happens that causes the sale period to extend. So a lot of times in these cases, people kind of think of like macroeconomic events. Maybe there's just during the period of sale that they're trying to search for an active buyer. The disposal group is priced fairly, everything is being marketed, but there's just a downward turn in the economy and maybe the buyer pool dries up or the people aren't just, looking as actively as before. And so it's taking a bit more time to complete that sale. If all those factors kind of align, and you still meet the rest of the criteria, you can also make a case for an exception for the 1 year.
So those exceptions seem to be a little nitpicky, and there's a lot of ands and ors there. So is there a place where somebody can go and look at this?
Yeah.
Where do we pull this from?
Yeah. So ASC 360, obviously, provides all this guidance. They actually have I think there's an example for each of these different types of exceptions in the guidance as well. So you can see some illustrative examples. So definitely to look at the interpretive guidance and the illustrative guidance in ASC 360.
Awesome. Well, let's move on to criteria number 5. And are there any exceptions to this rule before we dig too far in?
No, there aren't. Yeah, there aren't here. So Criterion 5 is basically saying that the disposal group that's being actively marketed, basically is being sold at a reasonable selling price that's comparable to the fair value of that disposal group. And really here, it's basically saying, if a disposal group is not being priced fairly, then it's probably indicative that management or the entity is not really intending to sell the group. Kind of back to if you're just testing the waters and you want to see I'm going to put a really high price tag on something and just see if anyone's willing to bite. That's kind of goes back to, other criterion that we've already talked about that maybe trip for there as well. So that's really what this is getting at, is that to really demonstrate that the disposal group is ready for an immediate sale, it needs to be priced, commensurate kind of with its fair value.
All right. And last but not least, criterion number 6, it is unlikely significant changes to the plan will occur or that the plan will be withdrawn. So what can you share on this one?
Yeah. So, basically if all the other criterion are met, it's usually pretty intuitive that there isn't going to be a plan to change things up and you don't expect one. Because it's hard to argue that you can meet most of those other ones if you plan to change things up, because you probably don't have a firm plan in place and you don't have an active program to market because you don't know what you're selling because you're changing that, or you're not sure what you're going to price it at, or whatever the case may be. So this is kind of that like catch-all criterion, but generally if you've got the other kind of ducks in a row, then this one should kind of fall into suit as well. When people are thinking about changes to plans, sometimes you just think about like historically, with what they've done with other maybe disposals that they've had, and kind of like what they're, have they made significant changes to plans in the past? What were the drivers of some of those things? Do they feel like there's any variables here, presently that could cause that it's likely that a change will occur? Those are maybe some of the qualitative considerations to make. But like I said, usually if everything else is looking pretty good, the 6 criterion will usually be met as well.
Okay. And before we move on to the next part, I'm going to tap into my inner Tim Garrity, and I came up with a groundbreaking acronym to help our listeners with these 6 criterion, because, you need to have this in memory. It's not like you can just go Google this stuff, right? All I came up with was Papa U, which stands for a plan in place, available for immediate sale, program to locate the buyer, probable within 1 year, actively marketed at a reasonable sale price, and unlikely significant change to plan.
I think that's well done.
Did I
Pretty
do it?
good.
Yeah.
You crushed it.
Papa you. Tim Garrity, watch out. I'm coming for you. All right. Well, we can get back on track. I keep doing the bunny trail thing today. We've got our 6 criteria. We have them memorized. You're welcome. How does one actually account for a disposal group that is classified as held for sale?
Yep. So a company will carry the disposal group at the lesser of its current carrying value or the fair value less cost to sell. So prior to measuring the group's fair value less cost to sell, a company really needs to evaluate whether assets that are not subject to ASC 360 and any related liabilities should be adjusted in accordance with the other GAAP. So specifically, you would perform impairment testing first over your other assets. So think like trade, your AR, your inventory, financial assets, etc. Then it would be your goodwill and indefinite lived intangible assets for impairment under ASC 350. And then you would go in and you would test your long-lived assets that are included in the disposal group. This it's important to point out that this order of impairment is actually different from assets held in use, where goodwill is tested last for impairment. So for assets held for sale, the order between long-lived assets and goodwill and indefinite lived intangible assets is flipped.
Okay, because we don't like to keep things straightforward, apparently. So you mentioned that we will carry it at the lesser of carrying value or fair value less cost to sell. So can we dig into that fair value less cost to sell calculation? What needs to be considered when determining the fair value of the disposal group?
Yep. So your fair value should be measured in accordance with ASC 820. It needs to be determined from the perspective of a market participant, taking into account, appropriate discount rates, valuation techniques, and other assumptions about the disposal group as applicable. The fair value also includes costs that a willing buyer and a willing seller would include in pricing the asset.
So what is included in cost to sell?
So any transaction costs that are expected to be incurred by the seller would be included in the estimate of cost to sell. So these are all costs that result directly from and that are essential to the sale of the disposal group. So said otherwise, there are costs that would not have been incurred if the company had not decided to sell the disposal group. So some examples of these would be broker commissions, legal title and transfer fees, and then closing costs. So when held for sale classification is met, a lot of those costs are not yet incurred. Therefore, management must estimate these costs. If the 1 year exception rule that Adam alluded to has been met, meaning the sale is going to take longer than a year to complete. These costs may need to be discounted. Internal costs can be included as long as they are incremental to and related to the sale of the asset. Another example, like bank fees that are paid to renegotiate corporate level debt as a result of the sale would not be included in these costs because the debt is not part of the disposal group.
Okay, so once management has determined its fair value less cost to sell, what's next?
Yep. So you would compare your fair value less cost of sale to the carrying value of the asset group. So let's say the fair value less cost of sale is $20 million, but your carrying value is $30 million. The company would then record a $10 million loss on sale. It's important to note it's not an impairment loss. And then going forward, they would start to carry the disposal group at the $20 million. So kind of reverse situation, if the fair value less cost of sale is $35 million and the carrying value is $30 million, the company will continue to carry the disposal group at the $30 million. So there's no gain that gets recorded. And that's because you can never write up the carrying value to higher than what it originally was on the date held for sale classification was met.
US GAAP always holding me back from taking gains. How does a company present assets held for sale in its financial statements?
Yeah, speaking of disclosures, there's also, some additional information you would include just about the assets that have been classified as held for sale. So, the most obvious is just really including a description of, the facts and circumstances that are going to lead to this expected disposal. What's the rationale for why they're planning to maybe get rid of this group of assets and liabilities. You maybe want to talk a bit about, the manner that they are going to dispose of it, the expected timing of when that disposal is going to occur, any gain or loss recognized, kind of what Nicole was alluding to. So just talking about any gain losses that were recognized, where that gain or loss is reflected on the income statement. So maybe just, describing the line item it's recorded in, if it's not presented separately. And then, to the extent that any of the disposal group was part of any of the segment reporting, just, talking about where that's reflected within the segment reporting under ASC 280.
All right. So if an entity writes down its held for sale disposal group because the fair value is less than the carrying value, how is that presented?
Yeah, so generally what you'll see, obviously, like I said, you're going to present those totals on the balance sheet. If you want to reflect just, a total assets held for sale, liabilities held for sale, et cetera, on the face of your balance sheet. But let's say like in your footnote, you're going to break down that list of assets and potentially liabilities. The way they reflect that adjustment is usually just some type of like valuation allowance. So it's kind of added as a reconciling item to that total list of the disposal group. And that's basically where that adjustment is tracked. So, it's a kind of a contra asset account, valuation account. It really isn't allocated like to the individual assets and the disposal group itself. It's really just reflected as a total adjustment. And then obviously, as you get into subsequent reporting periods, if you haven't disposed of the asset group yet, or the disposal group rather, any adjustments would just kind of run through that account as well.
Well, speaking of subsequent accounting, how often does a company subsequently assess the carrying value of the disposal group?
Yeah, so every reporting period, you have to, if you haven't disposed of the disposal group and it still meets the criteria to be classified as assets held for sale, then every reporting period, you basically have to look at the fair value less cost to sell, and you compare that to the previous reporting period's fair value less cost to sale. So if you kind of go back to Nicole's example, where I think you had, was it 20 million was the fair value? Less cost to
Yes,
sell?
I
Okay.
think so.
So if in the next reporting period, the current fair value less cost of sale increases, let's say it goes up to $21 million, we now have like a $1 million gain we need to record there. So we obviously would adjust that valuation account from, a $10 million adjustment down to a $9 million adjustment, and that $1 million change would go to a gain. And then basically bring our kind of cumulative carrying value of that asset or that disposal group to $21 million. And we would do this every reporting period as necessary. One thing she had mentioned as well is that, the upward adjustment in this valuation account, so the reduction of the original loss, like it can only go all the way back to that original carrying value of 30 million. In our example, you could never kind of go above and beyond that. So long as you have recoveries that get you back to that original carrying amount, it's fine. But any increases in fair value beyond that, we would never go above 30.
That's really helpful. I feel like that's easier to visualize that way. So let's say a company changes its mind for whatever reason and decides not to sell the disposal group, or the held for sale criteria are no longer met. How do they unwind the held for sale classification?
Yep. So the asset group would then be reclassified as held and used, and the carrying value of that asset group would need to be adjusted. So it's going to be now either carried at the lesser of the carrying value before held for sale criteria was met, and then it needs to be adjusted for any depreciation, amortization, or impairment losses that would have been recognized during the period that the asset group was classified as held for sale. Or you're going to carry it at the fair value as of the date the decision not to sell, or the date held for sale was no longer met. The new carrying value would then be compared to the carrying value just prior to the change in plan, and a subsequent write-up or impairment loss would be recognized. I should mention that once an asset group is classified as held for sale, the company no longer records depreciation, amortization, or impairment loss for the related assets of that disposal group. That's why when thinking about the initial carrying value, it needs to be adjusted to reflect those items if they were to reverse that classification.
All right, sounds like a lot of extra work. Maybe we should avoid those commitment issues. How does a company handle the presentation and disclosure of a change in plan of sale?
Yep. So the company would no longer present the asset group as held for sale in all periods that are presented in the financial statements. Adam talked about earlier, like if you had your major classes broken out and disclosed in a footnote, that footnote would be removed. And instead, the company should disclose what facts and circumstances led to the change in plan of sale. In addition, if any gain or loss is recognized as a result of the change in plan of sale, that gain or loss gets reported in income from continuing operations.
Okay, so another hypothetical. If a change in their plan happens after the reporting period, but before they issue their financial statements, is the classification impacted?
So if held for sale criteria is met after the balance sheet date, but before financial statements are issued or available to be issued, held and used classification still stands and is still appropriate within the financial statements. It should be noted that if the company is planning on or actually does sell the disposal group at a loss shortly after, so before the statements are issued, the held and used asset group should be evaluated to determine whether a held and used impairment loss existed as of the balance sheet date. Further, if the sale is completed after the reporting period, it may indicate that held for sale criteria was actually met as of the balance sheet date. So you kind of really need to rethink through that assessment a little bit. Even though the company would still present the asset group or the disposal group as held and used, the company does need to meet the disclosure requirements under ASC 360-10-50-3, which really essentially it's all the disclosures that are required as if the assets were really classified as held for sale.
Did you memorize that? The reference?
Did on my
notes.
notes.
They don't memorize. That's not the
That's only
expectation for
Adam
people.
memorizes.
Adam has them
Yeah.
memorized. Yeah. Well, anything else you want to leave our listeners with around held for sale, or are you capable of topping the Papa You mic drop?
I'll leave acronyms
That's-
to you
Yeah,
for
that's
sure.
for you.
All right. Well, if nothing else, then I think our listeners should remember that there are 6 criteria, Papa you, and that you have to meet all 6 in order for you to meet the classification. And you do not depreciate assets held for sale. I learned that one the hard way, and you learn more from your mistakes than from your successes. And that has never left me. Thank you, Adam and Nicole, for joining me again and talking our listeners through accounting for assets held for sale. And thank you to our listeners for following along on another episode of Accounting Matters.